Can I really retire at 53 with 1.35 million and a pension? What if you could retire at 53 and not worry about running out of money? That's exactly what one Canadian couple wanted to find out. They've worked since the early 1990s, night shifts, no kids, lived frugally, and saved consistently. And now they're mortgage-free, sitting on over $1 million in savings and dreaming of a quieter life in Nova Scotia. So the question is, are they ready? Or are they cashing in their freedom too soon? In this video, I'll walk you through their real numbers, the hidden risks they hadn't considered, and what the math actually says. I'm gonna show you how inflation, healthcare, taxes all add up. So if you've ever wondered, can I afford to retire early? This might be the case study that answers it for you. If you're new to my channel, welcome. I'm Jacqueline Ozdemir, a financial advisor here at Ferguson Financial Planning of CI Assante Capital Management. I help Canadians make confident decisions about their wealth, especially when it comes to facing big transitions, like stepping away from their careers earlier than expected and making an early retirement happen. Whether it's understanding how long your savings will last or how to structure your withdrawals to minimize taxes, I work with people who want to have a retirement plan that works in real life, not just on paper. And today, I'm breaking down a real retirement case study, a couple aiming to leave work at 53. I'm gonna show you not just whether they can do it, but what they risk if they don't plan it the right way. I'll touch on 5 key topics: how the numbers stack up, the hidden risk of inflation, losing health benefits, the tax trap of pension stacking, and how emotions play into this decision just as much as the math. If you find this video helpful, please hit like, drop a comment below if this story resonates, and don't forget to subscribe and turn on notifications so you don't miss what's next. Okay, let's get into it. Let's walk through the big question. Do we have enough to pack in at 53? To start answering this, let's lay out the numbers. For these folks, the plan is to rely on a $2,500 monthly pension, which they stated is not indexed to inflation, plus $250,000 in TFSAs, $950,000 in RRSPs, and $150,000 in cash. They are also mortgage-free on a modest house worth about $625,000, but they want to move closer to family. After all is said and done, they expect to spend most of that house sale on a new place in Nova Scotia for around $500,000, leaving some money for realtor fees, closing costs, and moving costs. I always tell people it's generally not free to move, so it's important to keep that in mind. Right now, they're comfortable spending about $2,000 every 2 weeks, or roughly $4,000 per month. That's before any unexpected costs like car repairs or maybe a sudden trip to see family come up. With their assets, you could do a quick back-of-the-envelope calculation and say $950,000 in RSPs, plus $250,000 in TFSAs, plus $150,000 in cash is $1.35 million. If we use a common rule of thumb of, let's say, withdrawing 4% each year from those investments, they could see about $54,000 a year before taxes, add in the $30,000 a year from the pension, and that will give them about $84,000 in total a year to live off of. Again, that's gross income before taxes and not factoring in future inflation. But that's not the full story. When they retire, they won't get automatic health coverage from an employer anymore. Also, when they draw from their RRSP, they need to consider the taxes that come out with it. Plus, even though TFSAs are tax-free, they still have to manage how they pull out the funds. So as you can see, the math suggests they might be able to retire next year, but there's more nuance here. So far, everything looks good on paper, but this money will likely need to stretch out for at least 3 decades and maybe more. We really need to make sure we factored in how inflation will impact their decision. We've all noticed the price of everyday items is creeping up, and that trend is probably likely to continue. A pension that pays $2,500 per month might feel comfortable in the early years, but it won't keep up with rising costs. Fast forward 10 years, and that same $2,500 may not stretch nearly as far at the grocery store. Even with normal inflation of 2% annually, the real value of that pension could shrink to just over $2,000 a month in today's terms. So what do you do about it? Well, if your pension isn't indexed, you will need a portfolio that can keep growing your money. When your RRSP or TFSA investments are structured well, the returns may help offset inflation's bite. Some people might hold a portion of their portfolio in equities like dividend-paying stocks. Others may look at bond ladders or other investments to manage risk, though in Canada, bond yields can be pretty modest. Imagine 5 years down the road, prices for basic groceries, utilities, and property taxes could be even higher. If you're not prepared, you might end up forced to reduce spending in ways you never intended, or worse, you could have to head back into the workforce part-time just to meet the gap. You need to plan for it if you want to preserve your lifestyle, especially if you plan on retiring early. You can counter inflation by tilting your portfolio toward more growth assets like dividend-growing stocks or real return bonds that historically outpace rising prices. Next, let's talk about benefits that often get overlooked. Health coverage. Right now, many folks enjoy some form of health insurance through their current job. It likely covers prescription drugs, dental checkups, and maybe even physiotherapy sessions. Once you leave the workforce early, those perks can go away. And if you leave before 55 at some workplaces, you might not qualify for retiree benefits. And that's the case here for our couple. So what does that mean for them? If one unexpected health event pops up, what used to be covered by health insurance now might become a significant out-of-pocket expense. And while our national healthcare covers hospital stays and doctors, the extras can really add up. Things like hearing aids, certain testing, vision care, or even some advanced prescription drugs might require private insurance or require paying out of pocket. Even if your spouse is older, maybe they haven't worked for a while, which means you're the only pipeline to group benefits, once you retire, that pipeline goes dry. The solution could be to purchase private coverage, but private insurance can be costly and the monthly premiums may eat into your investment withdrawals. If you're a business owner, one strategy might be to maintain a special health spending account where you set aside money within your company's financial structure formally for healthcare expenses. But this couple may not be business owners, so this strategy doesn't really apply to them. For our couple, they might use a separate TFSA or keep cash available to handle these costs. But regardless of their approach, setting money aside for healthcare expenses as you age is going to be very important. And ignoring the health coverage gap after you retire is very risky. Always keep an eye on this piece because it can quickly become a blind spot that derails an otherwise solid retirement plan. We need to chat about how taxes play into this. Many people assume, hey, I'll just live on my pension and tap my RRSP when I need it. But as soon as you start pulling money from your RRSP, that's treated as a regular taxable income. Combine that with your pension income, and suddenly you might be paying more tax in a year than you expected. It's a classic trap. The more streams of taxable income you have, the quicker you may jump into a higher tax bracket. Let's do a quick example. Suppose you're getting $30,000 a year from your pension. If you draw another $30,000 from your RRSP in that same year, that's now $60,000 in total income. Once we account for the basic tax credits, you might feel comfortable. But by the time you add in provincial taxes, it may take a bigger bite than you planned. For this couple, they are planning on moving from Ontario to Nova Scotia, so they need to keep in mind that each province has its own tax rates. In fact, the move from Ontario to Nova Scotia will result in an increase in their tax rate and is important to be addressed in their retirement plan. At $60,000 of taxable income in Ontario, their marginal tax rate would be 29.65%. But in Nova Scotia, that marginal tax rate jumps up to 35.45%. One strategy is to spread out your RRSP withdrawals more systematically, maybe even taking those withdrawals a little bit earlier than you were initially planning. Another is to make good use of your TFSA, which doesn't trigger taxes on withdrawals. You could also keep some money in a non-registered account if it makes sense, but that can have capital gains. So the decision on where to pull your money from first and how to approach it is an important one. I've actually covered this in a previous video, and I'll link to that here so that you can check that out as well. The bottom line is that dealing with multiple tax advantage accounts often requires a plan. If you do it right, you can keep your tax bill reasonable each year and make more of your money work for you over the long term. That's certainly better than getting a high tax bill after it's too late to do much about it. Finally, let's not forget about the biggest factor that nobody can measure with simple math: how you feel. Our couple in this case has been dealing with stressful night shifts since the early 1990s. They don't have kids, and that might change their sense of urgency around family legacy. But they do have personal well-being on the line. Leaving a stable job before 55 might feel like walking away from guaranteed security. So there's a real push and pull between desire and doubt. Because retirement isn't just about paying for groceries and property taxes, it's about waking up on a Tuesday morning and deciding what you want to do that day. Getting rid of the stress can improve overall health, and for many, that is incredibly valuable. But letting go of your daily routine and structure can also cause a sense of loss, especially if your job was part of your identity. Studies show that 27% of Canadian retirees regret leaving the workforce, and 23% have tried to return, often driven as much by a need for mental situation as much as the money. And then asked why they want back, 59% said that intellectual engagement was the main reason, and said that working reduced hours or even semi-retirement gave them the best of both worlds, balancing purpose with a little extra cash flow. Research on retirement well-being finds that maintaining routines, social connections, and activities linked to one's identity has a strong correlation with satisfaction. Without a clear plan for how they'll fit their days, our couple might risk boredom or loneliness, not to mention a decline in mental and physical health. That's why a solid retirement plan needs an emotional playbook too. Maybe that means mapping out new daily habits, setting up regular social activities, or even working with a coach or mentor to navigate the shift. Without addressing how you fill your time and stay engaged, you could find that money adds up, but your motivation doesn't. So let's go back to the question that started all this. Can this couple retire at 53? Based on their numbers, it appears they can. Their home is fully paid off, they have a decent pension, and a combined $1.35 million across different accounts. They live modestly on $4,000 a month. The math does work, assuming reasonable market returns and a solid plan for inflation, taxes, and potential health costs. That said, the real debate is whether they've accounted for the hidden edges that could catch them by surprise. Inflation may eat away at the spending power of their fixed pension. Their lack of workplace benefits could mean bigger healthcare bills, and a sloppy approach to RRSP withdrawals might produce unwelcome tax surprises. And the emotional weight of leaving a career can be heavier than you'd think. If they tackle these issues head on, it should be easier to adjust. Supplemental health coverage can help manage those unexpected health costs, and optimizing how and when they withdraw their money from their various accounts will definitely help minimize taxes. And having honest conversations about their day-to-day purpose will help make sure they fully enjoy the fruits of their labor. The key is to remember that retirement doesn't have to be a permanent off switch. If they find they need a financial or mental boost, a flexible part-time gig or consulting role could help. People often discover that they want to keep busy or stay connected to a community. In that sense, it's not about never going to work again. It's about finding a new balance where work is optional. My takeaway from this case study is this: early retirement can be more than a fantasy if you think through the details. Our couple's background has given them a big advantage, but everyone deserves clarity on the less obvious factors too. The safer your plan, the easier it is to enjoy your newfound freedom without staring at your budget every morning. Whatever timetable you choose for your own retirement, be sure that you see the full picture and that you're planning ahead for any unexpected scenarios that could derail things. In the end, you want a life you look forward to each day, whether or not you skip out before 55. That, more than anything, is what a thoughtful plan makes possible. For this couple, their savings and pension put them on a really solid foundation. And for them, it's the finer details that will matter. Fixed pensions will lose ground to inflation, health benefits may vanish the day you leave your workplace, and RRSPs, they can become a tax trap if you don't coordinate your withdrawals. Even if the budget says you're good to go, reality might have other plans. In the end, can this couple retire at 53? With a clear roadmap and smart planning, my answer would be yes. Drop your biggest what if in the comments, whether it's inflation, tax headaches, or just the nerves of calling it quits early. I'd love to hear from you, and perhaps I can tackle it in a future video. If you're wondering whether your version of early retirement is actually doable, and if you want to take a serious look at how this all applies to your situation, click the link in the description to book a discovery call. If this video gave you a better sense of what goes into early retirement, hit subscribe and the notification bell. That way you won't miss what's coming next. Thanks for watching, and I'll see you in the next video.